Hotter than expected inflation data for December throwing cold water on markets that were eagerly expecting the Fed to cut rates as soon as March. CEOs in the Conference Board's newest report weren't so convinced about inflation being tamed and named it one of their top concerns, along with recession. Are they right to be worried? Well, to break down the report, Dana Peterson, the Conference Board chief economist, is here. Good to see you, Dana. So as we look at what we saw with Great to have you. So as we look at what happened in December with consumer prices coming in higher than expected here, put that into context and what CEOs are looking at that made them think that inflation wasn't tamed.
Sure. We did see lots of slowing in inflation last year, but then December we saw an uptick in the headline for the CPI. The good news is that the core is slowing, but it's still well above what the Fed is looking for in terms of 2% inflation, especially for the PCE deflator. So that really syncs up with concerns among CEOs about recession and also elevated inflation and higher costs of doing business. So I'm really not surprised that CEOs ranked those two items as being number one and number two for their concerns for the outlook for 2024.
So let's break some of this down, because you have the external issues that they identified: economic downturn, recession, and inflation as well. But you also have some of the internal ones. I want to focus on those as well, because some things are beyond some of these companies' control. But what are they seeing internally as well that's adding to the mix?
Sure. The biggest concerns among CEOs internally was attracting and retaining talent. That also doesn't surprise me. When we look at the US, you still have a number of industries that are suffering from labor shortages. And certainly we have the baby boomer population shrinking as they're retiring. And some of that retiring got pulled forward due to the pandemic. So many companies are having difficulty finding not only more workers, but qualified workers and keeping them at the same time.
And then another element they were looking at was accelerating the pace of digital transformation. Of course, we have to talk about AI. It's been all the buzz here. How are they viewing that? And what sort of investments, how are they prioritizing it right now?
Digital innovation has been on the top of the list for several years. And certainly AI has really come to the top of the list. And in fact, we did ask CEOs about AI, and they said, we're actually really excited about it. And most of them were either already implementing it into their business plans or thinking about it. And indeed, they think that it's going to be very productive and also increase the bottom line, as well as raise profits and make their workers more productive.
And it's tough because we saw a lot of the enthusiasm in AI, but then you have a lot of workers wondering, well, what does that mean if more companies are going to be relying on AI for productivity? We've already seen some layoff announcements, mostly in companies, not just in companies that rely on AI, like Duolingo had their layoffs, but other companies continuing with layoffs as well. As you're looking at the labor market and the role that AI is playing in productivity, what are the expectations CEOs have there?
Well, for the most part, CEOs are kind of divided in terms of the impact on the labor market. Some of them think that is going to cause them to have to let people go. And then many of them think it's actually going to enhance the productivity of their workers. So there are definitely some risks and challenges around AI. Indeed, implementation, ethical use, regulation, all those pieces are coming together. And they do believe that they're going to need greater investments and greater integration among their workers to make sure that AI works for the company.
And as we sort of take a bigger view here and look at the global picture, we've already seen a global economic slowdown last year, and it looks like you're expecting global real GDP to slow even further to 2.5% in 2024. What's the base case there?
Yes, a big chunk of that is because Chinese growth is going to slow by about 1.1 percentage points, from 5.2% last year to around 4.1% this year. And that's a function of an aging demographic, very weak consumer confidence that's leading to less spending, and ongoing crises regarding the housing market. Also, we think Europe is going to flirt in and out with recession. Certainly, Europe and Germany may descend back into recession. So we're seeing a very weak outlook for Europe and China. And in the US, we still do have a call for a short and shallow recession that's going to probably dissipate by the end of this year, but that still calls for weaker growth this year relative to last year.
And Dana, of course, keep an eye on geopolitics, not just with Ukraine and Russia. Obviously, Israel, you have the Red Sea issues there with the Houthi rebels as well. And of course, the relationship between the US and China. How do you see that playing out in terms of disruptions and how we might see that impact the global economy?
Sure. We're already seeing we've already seen the disruptions from the war in Ukraine, and certainly the metastasization of the conflict in the Middle East has resulted in shipments being stopped and attacked in the Red Sea. And that certainly is a big negative for trade between Europe, MENA, and Asia. So we could continue to see this. And there are also many other low probability but high impact events that could come to the fore, and many of them having to do with geopolitics, the relationship between the East and the West, the US and China, et cetera.
We'll continue to watch that, of course, as they're both of their economies, the two biggest in the world, and also in that sort of high-tech standoff here with AI right in the middle of it as well. Thank you for joining us, Dana Peterson, the Conference Board Chief Economist. Thank you so much.
Thank you.